G'day everyone, welcome to the latest edition of the Professional Series podcast with WealthLab, Scott Jackson and Phil Sproule. How are you, Scott?
G'day, mate. I am well. Happy Friday. Happy, I don't know, what is it? Almost mid-year, listeners. We're halfway
Very
through
close.
23. COVID's now 3 years behind us. And we are dealing with what? What are we dealing with? We're dealing with inflation, higher interest rates, higher cost of living. Mate, life's always difficult, and there's always macro events that are going on. So in terms of your topics today,
I thought you said happy Friday, mate. It's just gone very depressing there.
Oh, make it more happy, Phil. What are we talking about?
Well, mate, today I was just going to have a bit of a chat about some of the intangibles, I guess, of working with an advisor. So, often people come to us looking for some sort of a tangible outcome, better returns, tax savings, whatever. But I think a lot of the value in long-term working with an advisor is some of the intangibles, help with decision-making, avoiding mistakes, that sort of stuff. So I was going to have a bit of a chat about that. What about you? What have you got for us?
Phil, that sounds really boring. So hopefully you can make it not very boring.
Well, mate, I'll do my best.
I'm ready for it. Right, I'm going to be talking about the 3-bucket investment strategy. I know we've been talking too much on this podcast about cash flow, and we've not been talking about enough investing stuff. So I'm going to be talking investments and talking investment strategy. So that's my little piece of the day. So let's kick into yours.
Yeah, awesome. So look, I think, as I mentioned, one of the big, intangibles that actually has really tangible outcomes is just having that sort of sounding board or someone to bounce ideas off, avoid making mistakes, and sort of help save you from yourself sometimes. If I think about like some of the things over the years in advisors that I've helped clients avoid, I can think of multiple times where I've stopped someone from signing up to a scam somewhere or some sort of dodgy investment that wasn't legitimate. Only a few weeks back that happened. So that's a super common one. Another really common one would be, large purchases that you can't really afford, all of that sort of stuff. So I always say to a client when they're signing on with me that, if you're working with an advisor, anytime you're making a large financial decision or a large decision of any type, really, that's going to impact your finances, we should be one of your first phone calls. Just like we were talking earlier, and I said I always wanted a Harley since I was a kid, and you told me I was an idiot. Sometimes you need that impartial or unbiased third party sort of, to snap you back into some right thinking. And look, on that topic, I'm an advisor. I've been an advisor for 12 years, and I've used an advisor. And I went into that meeting with some really set ideas about what I wanted to do and walked out doing something completely different. And the reason for that wasn't because I don't know what I'm doing, because I do. It was purely and simply I was too close to the situation. I was thinking about it too personally, and I needed an objective third party to really, call out some of the things that, because it was a personal situation, I hadn't really thought of. So I think that stuff's really important, and you can't necessarily put a value on it, although I have got an example to put a value on it. And the reason I've used this particular example, even though I've talked about all sorts of different, questions and things we can help people dodge, is this actually came from a conversation I had with someone a little while ago at a barbecue. So it wasn't even in a professional context. It was just having a chat at the barbecue.
The barbecue chat.
Yeah, barbecue chat, yeah.
I think I might just touch on. I really like how you said that. Like you were too close to it, and you needed to take a step back. So you're too caught up in it. It's your own world. It's your own thinking about, and just having that one person who's like a step behind the line, who's a step off the line, who can just go, oh, okay, that's not the right thing to do. Like you're doing this stuff, okay, but you actually need to make these additional changes. Is a really nice analogy for. I think just generally just using someone like us or using, like the accounting team that we use or the mortgage working team or the other professional services that we all have in our space.
Yeah, 100%. And I think like you just go back to that example of myself, the other big thing that I got out of that's potentially an intangible, but was really important for me was a level of comfort because, it's all relating to stuff for the family, for myself. And, if I'm not here, now I have the confidence that my wife has the phone number of somebody that knows the ins and outs of everything. So, I can know everything, but if I'm dead, that's no help to her. But having that other trusted professional, that knows the ins and outs of our situation, that's helped us put this together, I think makes a huge difference. So, whether you think you know everything or not, which, sometimes there's still a lot of value in seeking professional advice or an outside opinion. So back to the example of one of the common things. I guess this probably comes up a little bit, Scott, but I don't know if this particular case, I was talking to someone that said, I don't have a heap of super. Markets are down, my super balance keeps falling. I'm not going to have any money left, so I moved everything to cash to make sure I don't lose it. Right? Now, how often do you hear something similar, whether it's someone's done that or should they do that?
I have this unfortunate knee jerk reaction of, what about inflation? You're aware that making no decision is actually still a decision, and that is actually just being eaten by inflation. Yeah, I would still probably do that at a barbecue. And I don't know if I could stop myself from saying that, because I'm so passionately against that strategy.
Yeah, well, and I couldn't help myself, and I did say something along those lines. Provided some, you need to go and get some advice, but failing that, here's some studies to go and read. Here's some resources to read. That didn't look at any of it. So,
why would they? Yeah. Why would they? Yeah, I mean, did you know what I was looking? I was just looking because this is what I was looking at. The CBA, the Commonwealth Bank bonds. So Commonwealth Bank issues bonds, which is IOU notes, which are considered fixed interest, fairly safe, sit in a lot of portfolios. Those bonds are yielding above 6.5% at the moment, which is dramatically above a income that you'd be receiving from just the shares itself after franking credits. So literally the bonds are yielding more than the dividends from the share price. So why am I saying this? Well, it's an interesting one around making sure that you've got the advice and making sure you're not chasing after higher numbers or what would seem like higher numbers. And yeah, I was just looking at that before, and yeah, just an analogy of where times are at.
Yeah.
Putting all your money into a cash account is going to have you get eaten by inflation, and there are other opportunities available for someone seeking that consistent income.
Yeah. So
here we go.
Look, I actually did a bit of math because sometimes I just can't help myself with playing with spreadsheets. But this is the ASX 200, right? So this is it's an index. That's the biggest 200 companies on the Australian Stock Exchange. It broadly represents the Australian share market.
So Phil has his web browser open for those who are listening. Thanks, Phil.
Yeah, of course. Yeah, sorry. Go watch the video.
And we've got just using Google Finance to review the aggregate of the 200 biggest companies on the Aussie market, which is typically referred to as the market, because whilst there's over 2,000 companies listed on the stock market, the top 200 are dramatically
the 82%,
and represent almost
everything. The market.
There we go. Thank you very much. So continue.
So look, the reason I brought this chart up, this is over the last 5 years. You can see this big dip here, which was actually COVID, obviously. So from peak to trough, from the top of the market to the bottom of the market here is about a 30% fall, about 33% if you want to get specific. And one of these days just in here was the single largest ever recorded fall in the Australian stock market since they've been keeping records. But anyway, long story short, I had this conversation that I was referring to around about August 2020. So a little bit after the end of financial year statements were received for his fund for the previous year. Obviously, it didn't look great given what had happened. Parked everything in cash and has done nothing since. Now, you can see what the outcome from there is, because what's happened, the market's recovered. He's actually injured himself to the tune of between there, moving to cash, and today, about 20% worse off, having moved his money to cash here. Not even at the bottom of the market,
that's
just in somewhere.
That's excluding income as well.
Excluding the income, yeah. So you say that 20% is just based on the balance that was there. You think about all the employer contributions that have gone in since, the fact that any employer contributions that are going through this period, you're actually just buying at a discount. So it's like going shopping at the end of financial year sales. Missed all of that benefit because it's all just been going into cash.
Nice.
So actually, just to go a little bit further on that, threw together a spreadsheet just through a couple of different outcomes just to show, potentially what that means in a dollar value. So I've looked at from January, if you invested $100,000 in January 2019. Now, this is just a quick and dirty calculation. I don't want anyone in there saying, oh, you didn't account for interest because it would have been, 1% if you're lucky. Oh, you didn't account for employer contributions, whatever. It's just $100,000 invested in the market for an example. So just bear that in mind. But $100,000 invested January 2019. If you bought that and you held it to today and you did absolutely nothing, you're up 25%. So your $100,000 is now $125,000. If you invested January 2019, you sold out at the bottom of the market, so you moved to cash here. And then around about January 2021, you're kind of feeling a bit better about the world because stuff started to recover, so you reinvested your money. You're actually still down nearly 10.5%. So your 100 grand's now down to 90 grand, just under 90 grand. And even worse, if you had a crystal ball and you were some sort of magician that could accurately predict the bottom and the top of the market, and you did actually accurately predict the bottom and the top of the market, but you did things in the opposite way that you should have, and you sold out at the bottom and rebought at the top, you're actually down 20 grand. So really significant bad outcome. And this might seem like some extreme examples, but this is stuff that I see all the time, and I've seen it over and over and over again in my 12 years of advising clients. Now, no client of mine would have had this happen, or at least not without a significant argument with me, and probably not being my client anymore. So, I guess the point I'm trying to make is that it may feel like an intangible benefit having someone to ring up, hey, market's crashed, what do you reckon I should do? But there's some significant financial consequences to getting that stuff wrong. So look, there's a whole nother conversation we could have about, days in the market, days out of the market, best days, portfolio construction, whatever. That's probably a podcast in itself. I don't want to get too far down that rabbit hole. But suffice to say, it's not necessarily just the stuff that you come to speak to an advisor about, hey, get me a better return or get me some tax savings or whatever. Think about the long term as well and the silly mistakes we can help you avoid. It's my favourite saying, the biggest risk to any portfolio is the investor themselves.
Well done. I think, the answer, that answer question is like, yes. How can you, to answer the question of like, how can you get me a better return? Well, we don't have a crystal ball, but we've got a strategy. And that is, we're going to look after the funds. You go back to work, and then you periodically check in on the portfolio, but we're going to make sure it is what it's doing what it's supposed to be doing.
Yeah.
And that's sort of the relationship that we help people. So that's why someone should consider working with us. If that's not what you're after, then we're not a good fit. But that actually does quantifiably work, as per the graph you just had, just time in the market versus trying to time the market.
Yeah, exactly right. And there's a lot that we do up front with clients to help all that as well, as a big education piece, risk profiling, so getting a really good understanding of sort of things clients will be comfortable with, all that sort of stuff, so that we mitigate some of this, behavior or panicking when markets crash, because you understand what we've done and why we've done it. So, there you go.
Nice. I like it. All right. So I'm going to ping over to my topic now, and thank you for that. I'm going to be introducing the concept that I've been looking at the moment of the 3-bucket retirement strategy, or the bucket income strategy, or the bucket investment strategy, depending on which one you want to Google and what country you're in. It sort of has a slight different word. And I'm not advocating this is the strategy we use. I'm advocating this is a strategy to think about. There's lots. And in the same way that no single diet works, there's lots of different ones. I like this one because it's a little bit different to probably what a lot of people think. So let's say, for example, a real common strategy is just buying a house, paying the mortgage down, and then buying another house. Like and then letting your super grow. Like that has got to be the most vanilla strategy that so many Australians are doing right now. So the bucket strategy has a little bit more purpose and a little bit more nuances to it. So it's still a growth orientated strategy, but what it means is it dividing your income, assets, and wealth into 3 specific sections.
Oh, gee, what are we investing for? I think that's kind of
yeah, correct. And I actually found what I was trying to find before. So this is a short, medium, long term. So this is what Vision Super, which is just a large super fund, they're advocating. Well, they're always going to be trying to index hug. So they're going a cash bucket, a conservative bucket, and a growth bucket. I feel like it should be I feel like this should be someone who I'd be advising. It'd be closer to like 3 months expenses, whatever your somewhat surplus income, and then YOLO the rest, so to speak. And YOLO the rest is
within reason.
Let's say we look at a family income of say $12,000 a month. So you and your partner, if that's what your net income is, 10% of your income is going to be going into super anyway. So we'll call it that's going to go in there. You got to make sure that your bills and expenses. Let's say you're spending 35% of your income on mortgage or rent. Certainly interest rates are way high, but let's say $3,500 to $5,000 is going on your mortgage, so that's going to leave you with a surplus of about $6,000 to $7,000 of living expenses. Let's say, for example, you've got $4,000 to $5,000 of living expenses, giving you with a surplus of about $2,000 a month. Let's say, for example, we'll be putting, say, $2,000 a month into this bucket here. If we've got the actual buckets, there we go. Let's say $2,000 a month into this here, and this could be the big holiday fund or whatever it is. But you're just consistently putting that $2,000 a month until it's full. And then once we hit that point, and this work with your advisor to identify what these dollars are at, then we salary sacrifice the remaining surplus into this strategy here. So you've got your 10% super plus, say, for example, $2,000 a month surplus with this one full, this one full, and this one full. That is a great strategy for building wealth.
I like it.
I like it too. All right, that's it. This is a longer episode, guys, but we got distracted talking investments. The only other elements I would add, which is obviously work this strategy with a professional, seek advice, and do consider this only as general advice. But these are things that you should be talking to your partner about. These are things you should be talking to your family about. I think money should be talked about at the table. I don't know if you disagree or agree with me. What do you think?
No, 100%. Yeah, just be careful who you take advice from.
All right, that's a great note. Thanks, guys. Have a great week. See you in a fortnight.
Cool. Cheers. Thanks, guys. Bye.